Hey, Jonah, thanks so much for joining Voices of Wall Street. We're going to talk about some of your favorite stocks. We're going to run through a few of your investments that you've closed positions on, and we're going to break down why you target companies with a market cap of under $10 billion. But before we get into all of that good stuff, talk to me just about, you're known for making top stock picks and for picking companies that go up by a lot in a very short amount of time. What are your three favorite stocks for 2021?
A couple of the stocks that I'm really bullish on. One is Teladoc, which is clearly a telehealth company, but they made an acquisition this past summer of Livongo, which added, I think, an important dimension of what is the future of healthcare. Another stock I'm really bullish on that I was going to write about today in my newsletter, but it was up 20% just after the open, and that's DermTech. So DermTech has created a patch to help identify skin cancer. So the old way of, skin, cutting out a piece of skin and having it analyzed to determine if you have skin cancer, this is a patch, and the cells that essentially attach to the patch can be analyzed. And considering that two of my family members have advanced melanoma and one of them just died from melanoma last week, this is a company that I've been kind of digging into, and it's just very, very interesting company. And then,
so Jonah, can I ask you real quick though? You've mentioned this a couple of times, and I think anybody watching the market has noticed how high valuations have gotten. When you're looking at the market right now, you say you're bullish, but you talk about companies up 60%, 70% since the start of the year. We're only in about week 2 of 2021. How are you looking at that? I mean, is it time to maybe pull back, or are there companies that you wish you could get into, but they're just a little expensive right now and you're waiting for a pullback? What's your thought there?
So there's a lot of companies that would love to own, but I'm just not willing to chase them at current prices, typically because they've either had a recent run or just the price to sales multiple is something that I'm not comfortable with, or, if I look at the technicals, they're poking through the Bollinger Band. So, I'm probably 80% fundamental and 20% technical. So I do look a lot at moving averages, Bollinger Bands, RSI. So so let's take Futu, for instance. So I got into Futu a few weeks ago when it had pulled back it rallied up into the low 50s off the summer, came back down. I thought it was going to bounce off the 20-day moving average. So I started a position. It didn't. It blew right through the 20-day moving average. So then it looked like it might bounce on the 50-day. So once it got close to the 50-day, I think I tripled my position, and we got a massive bounce off the 50-day. It ripped probably 15% that day, another 15% the next day, which is when it went into my newsletter. But now it's, 75, 80% off of that 50-day moving average. So it looks like it's probably overdue for a pullback, but it was up another 15% today. So, that's a company where the fundamentals look phenomenal. It grew 150% last year. It's going to grow another 50, 60, 70% this year, 80% gross margins, 30, 40% EBITDA margins. So, the metrics and the fundamentals are there to support the current valuation. It was just very, very undervalued and unknown a few weeks ago.
Yeah. So are there other companies like that you've got your eye on?
But then you also take a company like Celsius, right? So Celsius is an energy drink company. I drink 1 or 2 Celsiuses every day. I know people at the company. I love what they're doing. They were selling a lot of their product through gyms, and then the pandemic hit, and they really had to pivot into an e-commerce. And now that the gyms are opening, that's becoming another channel. But then they've also signed big deals to go into retail stores. On a price to sales multiple, it's crazy. The valuation is insane. It's at, it's like 25, 30 times for an energy drink company with 40, 45% gross margins. It makes no sense. But if they continue signing these big deals, these big distribution partnerships, then, the stock goes higher. It's just as simple as that. So it's so hard. And that's why I love these small cap stocks, because there's just so much potential with a $3 or $4 billion company. A couple big deals or partnerships or contracts can really move the stock versus, a $700-800 billion company like Facebook or, Google. I can't get excited about those companies anymore. I'm looking for the next Facebook, the next Google. So, and I just think since I'm doing a newsletter and I'm writing about these companies and I'm trying to find stocks that are not on everyone's radar and watch list and stocks that FinTwit is not already talking about, I think I can bring the most value in these smaller cap stocks that people just haven't heard about. They haven't had a chance to dig in and do any research.
And is it still true that you've got about 50% of your portfolio in some of these names that are under $10 billion?
Oh yeah, definitely. So my biggest holding is Futu. That's under 10 billion. The next 3 or 4 stocks though are Square, Teladoc, CrowdStrike, and C Limited. So those are all over 10 billion. A couple of those are actually over 100 billion. But then after that, so after you get out of like my top 6 or 7, most of the stocks that are left, I have about 35 stocks total in my portfolio, and I would say almost the rest of all of them are under $10 billion. So, when I'm building a portfolio, it's not just about the stocks that I think have the most upside. It's that risk versus return and what's the upside versus the downside. And clearly these small cap growth stocks, especially the ones that, aren't producing a lot of revenue yet, or clearly are not profitable yet, there's a lot of downside too. So, when I talk about a stock like DermTech or, Mohawk, or for instance, I mean, these are high growth companies. And if the markets pull back in 2021 and those multiples, contract, you could see these stocks pull back 20, 30% pretty easily. Not that I don't think it's going to happen, but it always could.
I want to talk about 2 stocks that you have gotten out of. That's Lemonade and DraftKings, 2 of probably the buzziest, kind of hottest stocks of certainly 2020. Why'd you get out of those positions?
So when I buy a stock, like I said, I'm typically looking for a stock that I think has 50% upside over the next 12 months. If I can get it sooner, that's great. With DraftKings and Lemonade, I just felt like I had to sell them when I did, because the Lemonade had run too fast, too far too fast. So I got back. I owned Lemonade earlier this year, and then I just got uncomfortable with the valuation. But after I dug into Upstart, for my newsletter a few weeks ago, I really started to understand the potential and the power of AI to disrupt these massive industries. Clearly, Upstart is going to do it for credit, and then Lemonade could do it for insurance. So the research I did for Upstart actually convinced me to get back into Lemonade, because Lemonade is trying to do that same thing for insurance. So I got back into Lemonade just a couple of weeks ago, under 110. And then over the last week or two, Motley Fool pumped up the stock. Some analysts came out and, gave some strong buy recommendations. And yesterday the stock was trading, close to 180. And I just felt like it was better to lock in a 60% profit in 2 weeks, walk away and put that money somewhere else, maybe in some stocks that haven't had a big move. And it, turned out to be a good decision, because after the close yesterday, the company actually announced that they were doing a secondary stock offering. Not that I knew it was coming. It was just kind of dumb luck, but sometimes dumb luck is all right. I still like the company, but I think the valuation yesterday got up to $9 billion. And I don't think the company is going to even do 150 million in revenue this year. And just the valuation, even if they disrupt the insurance industry, it's not going to happen overnight. And I just think when you can pull the trigger and lock in profits, 60% profits in a couple of weeks, 90% of the time you should do it. Because 90% of the time that stock's going to pull back and you're going to regret not getting out. So, I'll buy it back. If we get a 20, 25% pullback in the stock, I'm happy to jump back in. And then DraftKings. So DraftKings was just kind of a gut reaction on a couple things. So Governor Cuomo announced that New York is, he's getting behind the online sports betting. I thought the stock would actually pop more than it did. So I was thinking maybe that news was already so like baked into the stock already and already so anticipated. Right. The other thing that concerns me is I'm a big Michigan Wolverines fan, and our last couple of games have gotten suspended or postponed because of COVID. And I'm also a Celtics fan, and our last couple of games have gotten postponed because of COVID. And you had the college football season ending last night. NFL season ends in a couple of weeks. And I just kind of a gut feeling that maybe, if COVID starts to get out of control in the NBA or college basketball, and you see more games getting canceled, the seasons could get postponed, and then the stock sells off 10, 15, 20%. So, I had a 25, 30% profit in the stock. I got out at 54. And once again, if it pulls back into the mid 40s, I'll jump back in. If it rallies into the mid 60s, kudos for everybody that stuck with it. But there was other stocks that I wanted to add to yesterday. So I just, in the moment, it felt like the right thing to do.
And Jonah, last question I'll ask you, because I think you're a guy who a lot of people look to and they just see the wins. They see, 60% gain or 10 bagger here, things like that. But can you talk about some of the lessons the market's taught you? Because, before I think we came on, you were talking about how important that is to understand that the market can turn, can reverse on you. Can you talk to me about some of the lessons that you've learned and maybe some of the things that weren't winners? Because I think everyone I've talked to on Wall Street will tell you that they can't all be winners.
Right. Oh, for sure. I mean, I don't know what my batting average is over the last year, but I think a lot of people have had good batting averages over the last year. We've had a very bullish stock market, at least since the bottom in March. So it was hard to lose money in the stock market between, end of March and end of the year. I mean, I had a good year, but most people did. So, but I mean, I do think going forward, we're now into a stock pickers market where you do have to be more selective about what you own. And I think owning stocks over the indexes is the right strategy. And so my philosophy has always been, and it will continue to be, stocks go up over the long term, but they don't all go up at the same time, and they don't go up in a straight line. So you have to know when to be greedy, when to be fearful. Don't be greedy after 3-4 big days in the market. Just because I love Mohawk and Futu and some of my other stocks that have been big winners, I trimmed a bunch of them today, and I trimmed some of them yesterday, and I can build cash a little bit and get ready for a pullback, or I can add to some of my other stocks that, recently pulled back, right? Because some of my stocks are ripping while some of them are pulling back, and that's where I move money around. But I've been more or less in the investment business for 20 years, not managing capital the whole time, but I've been around the markets for 20 years. When I got into the business in 2002, it was the end of the dot-com crisis. So right. A lot of the clients that I was meeting with had just lost 70, 80% of their money in that debacle. And then I managed client capital through the financial crisis from 2009 until 2011. So, and that was brutal. I mean, that was 2 years of just grinding lower, watching a lot of big banks, historic firms go out of business. So I still have the scars from those two, epic events. And, so that's always in the back of my mind. I'm not one of these guys that's going to, ride a hot stock, after it's already rallied for 100, 200%, unless I really believe in the fundamentals of the business. Then in some cases, I'll start a small position with a tight stop loss just to protect myself. So,
stop losses are important.
Yep. Very important, especially if you're trying to play the momentum game. For instance, Tesla. So when Tesla got added to the S&P 500, I tripled my position. I knew it was going higher. I didn't think it would go as high as it did. So I sold out all of my Tesla a few weeks ago at 700 because I just didn't know what was left. I mean, I never imagined that Tesla would rally up to 850. So
yeah, I don't think many people could imagine what's happened with Tesla.
It's bonkers. I mean, there's no good rationale. You can't point to the fundamentals or deliveries or anything and rationalize a, $800 billion market cap for Tesla right now. Now, maybe the company's worth $800 billion in a few years and people are willing just to pay up now to get into the stock. I get that. I mean, that's definitely part of their story. That's kind of the whole the cult, the cult following. But it doesn't mean I have to try to ride that too. So I would rather jump out at 700, allocate that capital to other positions that I think have more upside over the next 12 months. And then if Tesla pulls back, I'm happy to jump back in. So, if Tesla pulled back to the 10-day moving average, I'd probably start a position. And then if it pulled back to the 20-day, I'd probably double the position. That's kind of how I think about it. But sometimes you just have to let these stocks run without you. You can't own them all.
That's a good thought. Hey, Jonah Lupton, thank you so much for being with us on Voices of Wall Street.